Hello, my name is Joe Blondin, and I'm proud to be the president at Clark State College. Clark State is so honored to be the lead sponsor for the Pursuit of Excellence series at the Logan County Chamber. And I'm Tony Oberholzer. I am the Vice President for Advancement and Outreach at Clark State. We're here to support your workforce needs. Please contact us if there is anything that we can do to support you, including with funding support if necessary. Clark State has a lot of opportunities to get training paid to make your company even more excellent than it already is. So please be in touch, and thank you so much.
Hello, this is Wyatt Wilcoxon from NexGen Accounting. Today, we're going to be talking about how to read some essential reports for your business out of QuickBooks Online. So first, you're going to see I have my demo company pulled up. We are going to want to go over to reports, standard reports, and we're just going to cover some high-level reports today, such as your balance sheet, profit and loss, and we'll also go over cash flow. So first one we're going to pull up is the balance sheet. So what you're going to want to do is make sure that this is ran for the period that you need. I would caution anybody, please make sure that all accounts are reconciled and your accountants are good for you to pull reports, or better yet, just ask your accountant to pull them so that they are the most accurate. But once you have the dates in here, you're going to select the accounting method. I'm going to guess most are cash, but some may be accrual. Again, cash is when it hits the bank. Accrual is when the service is provided. We are going to look at our profit and loss for January 1st to August 15th. First section is our income. So this is going to reflect any income categories that you need for your business. So this is a landscaping company. So they're designing things, they're giving discounts. You can have discounts in the income section. They have it broken out by, income for materials and then labor income. So whatever you need for your business, you can put in there. So for a bakery, you're going to probably have pastries, coffee, merchandise. So then it will show you the total income for that month. Looking at our cost of goods sold are anything that it takes to make a product. So if we use our landscaping company, I'm going to assume they have some fertilizer services. So the fertilizer needed for the service would be considered a cost of goods sold, because you have to have fertilizer in order to fertilize the yard. So then gross profit, that is the amount of money remaining after you have used the materials to make the product. Gross profit from that month is then used to pay all of your expenses that it takes to run the business. Again, all of these chart of accounts will be unique to your business, and your accountant has probably set it up. If not, let's talk. Looking here, they have some sub-accounts, automobiles. You can have fuel, repairs, whatever you would need. You don't have to break it out that detailed, but some choose to. We recommend a simpler chart of accounts so that it's not pages and pages of unnecessary data. And so, more expenses. And then once we get down here, after we've paid all of our expenses, our remaining income is this $4,558.46. So then from there, you might say, well, hey, there's other income. Shouldn't that be up in the top? No, because other income is typically stuff that's unreliable, that is not related to your line of service. So a lot of things that we see in other income is credit card rebates, and then you'll have other expenses. I am not a huge fan of having a miscellaneous column on our profit and loss, just because it should be going somewhere on the profit and loss besides just a miscellaneous account, because it relates to business more than likely. If not, it should be going to owner's draw if it's personal. So then from there, we are subtracting the miscellaneous expense, even though we don't know what it is. And that leaves you a net income for the month of this remaining number. So for Craig's Landscaping, it's $1,642.46. That is the basic for your general profit and loss. Now, if you want to get fancy and you need to look at a couple different things, you can adjust how you're displaying. So I want to look at this by month, and then it will go ahead and break it out by month for the time period given up here. That is probably one of my most used things. I would also say profit and loss by class is a good one. You can use classes for if you have multiple locations, multiple stores. Then the next report we're going to look at is the balance sheet. So the balance sheet shows all assets and liabilities of a business. Going through this real quick, assets, our bank account assets, our accounts receivable, money that's owed to us, other current assets, assets that we expect to have in a year. So, undeposited funds, those are typically cleared out every month. And then current assets. So there's $9,900 in current assets. Then we have fixed assets. So this is where the total cost of, for example, trucks are. So the original cost of the truck that they bought was $13,495. Typically at our firm, we put anything to assets that is $2,500 and above, unless there's good reason not to. But you will see a lot of vehicles and properties and stuff in fixed assets category. And so it just totals all of that up for us. I'm going to condense that since we've reviewed it. So liabilities and equity. Liabilities is money that you owe people. So accounts payable, what vendors do you owe? What checks do you still need to cut? Again, this number here is contingent on all of your bills being put in QuickBooks for payment. Credit cards, how much money do you owe to your credit card company? It looks like the MasterCard is at $157.72. Other current liabilities. So this is liabilities that are to be paid. So 12 months, a lot of it's payroll stuff, government refunds, loans. So it looks like in this account, there's nothing due to the Arizona Department of Revenue, the Board of Equalization, that's probably payroll, and then the loan payable of $4,000, which is in the current liabilities because it's expected to be paid in less than a year. So then you go to long-term liabilities. So that's anything 12 months and over. And it looks like there is a loan for $25,000. Let's talk about the liabilities for a second, as well as the assets. All of these reports, I would be very hesitant to run if it is not all reconciled. Again, this is where I would either ask your accountant or find an accountant who knows, hey, where's the closing period? Because if, as for this date, we're in the middle of August, typically when you reconcile, you are reconciling at the end of the month. So we have a half period. So all of this I would consider draft and subject to change. Typically it's the previous month by this point in the month that is solid and closed out. All of your bank accounts, everything will be reconciled out. And then so will your liabilities. So as this balance changes, this is typically tied to every month. In the loans payable, book payments will be booked against that down here. What did the loan go to pay? It would be booked in there as to that account. All of that to say, these numbers change. They reflect what the balance is as of the closing period of your books. Looking at long-term liabilities, this is anything that is 1 year and beyond. Notes payable, it looks like there is a $25,000 loan. If they did take a loan out on this truck, here's where the original cost of the asset would go. Depreciation would be in here from your tax accountant, and then the loan would be down here in this section. So, all right, the next part of our balance sheet is the equity section. So going down here, first we have retained earnings. Retained earnings is anything that the business has made over its life. Retained earnings, it increases when the company has profit and keeps it. and it decreases if the company is operating at a loss, or if it's always just been bleeding money, or we pay out some of the income to our owners. For example, retained earnings, we started the year with 50 grand from the previous year. Great. This year, we lost $20,000. So at the end of the year, our retained earnings is going to be $30,000 because let's just say the year's over. Last year we made 50, this year we lost 20. So over the life of the business, we are 30 grand positive. But it looks like for this demo file, we have not made any money in previous years. Net income, when using QuickBooks, this number will filter over from your profit and loss. So it will always tie. It shows it'll be positive or negative. It looks like they were positive for this working period, but it will be negative sometimes. The goal is not to, but it does happen. And then opening balance equity, this is supposed to be a temporary account. So say you've linked a new bank account to your QuickBooks file. We need to have all the activity in there, but when it links, it just takes the starting balance of the period that you're pulling in from your bank and it puts it to this opening balance equity account. So we need to make sure that any data to get up to this number that has been imported is in our QuickBooks file. If you get to that and you have no clue what to do, again, this is something that I would ask your accountant about. So then one other thing I want to highlight in the equity accounts is owner's draw. So owner's draw is for those of you who like to run a lot of personal expenses through your business. You are allowed to take money from your business, and that is where it goes into owner's draw. You know, say you went to lunch and it was a personal lunch, that would go to owner's draw. Or if you purchased a personal vehicle, that is also in owner's draw if it does not qualify as a business purchase. All righty, and the final report that we're going to talk about is going to be the statement of cash flows. So again, when you're running these reports, if you want to compare apples to apples, you need to make sure the date is correct. So here we go, statement of cash flows. So the first thing we're going to look at is our net income. Again, this will flow all together from your profit and loss. The next thing we're going to look at is what have we done with our cash this month and where is it? So accounts payable, this is, money that we owe to vendors and we're holding the cash instead of paying them yet. So we're conserving cash. Accounts receivable, these are unpaid invoices from customers. So we're collecting less cash. Again, Arizona Department of Revenue payable, there was no activity for this month, so it's nothing. The Board of Equalization, we owe this money to them, and so we haven't paid it yet. We're conserving cash. When we look at this charge for $596.25, we bought more inventory, so we used cash. Looking at this loan payable, it's a liability and it's a short-term loan. So we brought in cash and we're going to use it towards operations or whatever that loan's for. And then the MasterCard, we used credit. So we're also conserving cash in that way. And it is $557.72 there. We have, net cash provided by operating activities. This is how much cash that we have freed up. If we go down here and look at financing activities, so we paid $13,495 for this vehicle, and the cash went out to buy it. So that is going to reduce cash. Then if you go look at financing activities down here, we have our notes payable. So there's a $25,000 loan. We borrowed money, and so we get the money, and then we have our opening balance account over here. And, like we said, we're going to just treat this as an equity account. So this is going to be the equity number over here. So looking at this, we had an increase in cash in $4,063.52. So they tie out. We had no cash in the beginning. We made $1,900 from running the business. We spent $13,500 on a truck, and we brought in $15,600 in loans and financing things, leaving us with this amount in the bank. So to summarize all of this up, when we're looking down at here, we did not start with any cash at the beginning of the year. So with all of this, once you consolidate it all, we had a net cash increase of $4,063.52. And that is also going to be our cash at the end of the period. Now, if there was cash at the beginning, it would be like reconciling a bank. The cash that we had, maybe that was negative. So then the cash at the end is also going to reduce. If it was positive, that's going to increase. The cash that we made is good. So when that number is positive, that is good. But you do have to keep in mind, all of this has to be paid back at some point. And so this needs to be used as a tool to project how much money you need to spend in these certain areas. Very similar to the balance sheet. All three of these reports work together. So first thing is we need to have our balance sheet solid. If you have accounts and liabilities that aren't being reconciled out, then we can't guarantee that your profit and loss is going to be reconciled and as correct as it can be. Because if you have holding accounts, if you have the liabilities, like we said, if you have stuff that's just shoved to balance sheet accounts and owner's draw, like we need to make sure that those are correct so that our profit and loss can be correct. And then once those two are correct, then the cash flow report just summarizes both of those together. So once again, my name was Wyatt Wilcoxon with NexGen Accounting. If you are looking for an accountant who is responsive, who's tech savvy, and who, we truly take pride in partnering with our businesses. So if you're looking for someone who works as hard as you and all of that sounds like something that you would like to see in an accounting firm, feel free to give me a call.